Hello everyone, and welcome to Virginia International University's MBA 636 Managerial Accounting course. Today we're going to be talking about Chapter 9, which deals with the master budget and the budgeting process in general. This is a very important concept because there's really no management tool that gets used as much as the budget does. And there are implications with respect to budgeting that range from a compensation perspective, so how is a person's bonus or perhaps their mobility determined. There are management action and control perspectives with respect to the budget, and there are feedback perspectives with respect to the budget. And so we see that there are, budgeting is very important in today's business. And so I think this is a good chapter for us to focus on this aspect of accounting, since as managerial accountants, we're the ones who generally coordinate and distribute budgets and distribute comparisons between actual and budget. So let's talk first about how managers use the budget and why they use it. Budgeting is probably the most widely used management accounting tool. And when we think about it, just as in your own personal budgeting experience, it's a plan for a specific period of time, and it's geared to help management determine how to use resources. And so that may mean acquiring new resources, and budgeting provides a tool for the decision to acquire or not acquire resources, how to reallocate existing resources, or when we need to or feel that circumstances warrant that we're going to dispose of particular resources. And so it's used to estimate future cost and revenue. And so when we think about budgeting, we need to think of it as an ongoing process that creates long-term goals, that setting key strategies for obtaining goals, and then putting plans into action and analyzing the results. And so that's what this iterative sort of ongoing illustration here is meant to portray. We are developing and creating long-term goals. We're setting key strategies for attaining these goals. We're putting plans into action. We're acting on these, and then we're analyzing the results and reacting accordingly. And so there are different types of budgets, but one that's really, I've heard a lot about here recently is this idea of a rolling or a continuous budget. And so that's simply a budget that is continuously updated so that the next 12 months of operations are always budgeted. So, for instance, if we start in January of 2015, in January, I have a budget for calendar 2015 that takes me through the end of December. In February, I have a budget for February of 2015 to February of 2016. In March, I have a budget from March of 2015 to March of 2016. And so we are just continually updating our budget for one more month as the most recent month falls off, so that we have a 12 months of operations that we're always looking at. We also talk about participative budgeting, and this is budgeting that involves many levels of management, so that lower level managers close to the action have more detailed knowledge, and they're more likely to accept and be motivated by budgets that they help develop and create. So there are benefits to it and disadvantages to it. The benefits are, as we said, that these lower level managers are more likely to accept these budgets since they were a part of drawing them up. The disadvantages are that they are more complex and time consuming. And if we get these lower level managers involved, sometimes they may build slack into the budget, and that may be because of uncertainty about the future, so they just don't know, and so they want to be more conservative by understating sales and perhaps overstating costs than they might otherwise be, or performance perspectives. They want to make themselves, by coming in better than budget. If they built slack into the budget, they may want to assure themselves this performance perspective. And then they have resources in the event of budget cuts. So that so these are all just ways of gaming the budgeting process that may happen as we push the budgeting process down to the lower and lower levels. And so the starting point for developing budgets could be either the prior year budgeted figures or actual results, which are modified to reflect new products or services, changes in marketing by competitors, changes in labor contracts, inflation, or new strategies. But the real issue is here that we're starting with prior year budgeted figures or actual results, or we can also develop a budget using a zero-based budgeting. And this is where we start from zero every year and we require justification from managers for every dollar they put in the budget. The disadvantage of this is very labor intensive, as you can imagine, and very time consuming. The disadvantage of the first item, using prior year's budgeted figures, are that we really never stop to ask under that scenario, did we pay too much for that? Are we paying too much for that? Is there a better way to do that? Or are we just taking the status quo and continuing to build on that each month? So there are some benefits of budgeting, right? They force managers to plan, right? They promote coordination and communication throughout the company, and they also provide a benchmark or provide a target toward which the collective can work toward. So there are benefits to budgeting that we don't want to overlook, and there are many other benefits. These are just the main ones that we think of. So then we want to talk about, what is the master budget? The master budget is a comprehensive planning document for the entire organization, and it consists of all supporting budgets. So all these supporting budgets may include the operating budget, and then all of the budgets that are developed as a result of the operating budget, and the financial budget, and the budgets underneath the financial budget that are developed through the process. So when we look at an operating budget, we're really talking about the day-to-day operations of a company and the budget that gets us through those day-to-day operations. We always start with a sales budget, so we know, based on our market analysis, our competitive analysis, our targets for growth, and other qualitative measures, we start with a sales budget. That in turn, so if we have our sales budget, we'll know how much we need to produce in order to meet that sales budget. What are the units required? If we know the units required, we're able to back into what the direct materials budget, the direct labor budget, and our manufacturing overhead budget should be. And so that gets us down, once we develop those three components, that takes us into our operating expense budget, which we can then convert into a budgeted income statement for the coming period. So again, the operating budget tells us the budget for the day-to-day operations of the company. And as you can imagine, from each of these different budgets, there are other lower level budgets as well. Then we talk about financial budgets, right? So we have to convert our operating budget into, starting with the budgeted income statement, into a financial budget that includes capital expenditures budget. So do we need to buy new equipment, new capital items in order to meet the units of production we need? What are our cash needs? What are working capital needs that we have in order to support the budget that's reflected in the income statement? And then also we can translate this into a budgeted balance sheet. And it's this capital expenditures budget, cash budget, and budgeted balance sheet that we talk about with respect to financial budgets. So then let's talk about, how do we prepare the operating budgets? So when we're talking about a sales budget, that becomes the basis for every other budget. We plan for sales revenues in future periods, and once we've gotten that, we end up turning that into a total sales revenue, which is comprised of the number of units to be sold times the sales price per unit. The rest of the operating budget depends on the sales budget. So let's take a look at an example of a sales budget. And so this is Exhibit 9-5 out of our book. And what we see is that we're developing the budget here for January, February, March, the first quarter, and we're developing the sales budget. So we forecast that we're able to sell in January 30,000 units. We forecast we'll be able to sell them at a selling price of $20 per unit to give us total sales revenue of $600,000. We also understand that based on history, based on what our experience tells us, that $600,000 won't all be paid in cash, obviously. And we see that we typically have a mix of sales, some cash, 20%, and some credit sales of 80%. And so we're able to develop those. We look in February, and we are going to estimate and project that we'll sell 20,000 times the 20,000 units or cases times the $20 per case to give us total sales revenue of $400,000. We apply the cash and credit sales the same, right? So $400,000, we've got 20% of that will be in cash, and then 80% of that, or the difference, will be in credit sales. And then finally, in March, we anticipate selling 25,000 cases, $20 a case, to get us $500,000. If we apply the same cash and credit ratios, we get 100,000 in cash sales and 400,000. So when we look at the first quarter budget, we can see that it's just simply the January, February, and March results combined. And so this then becomes the sales budget upon which many other subsidiary or lower level budgets are based. And so the production budget we develop after determining the number of units to be sold. Then we can decide the number of units that we need to produce. And we talk about what our basic format of that is. So we need the units needed for sales, plus the desired ending inventory, right? We probably want something left over in inventory, equals the total units needed. And we reduce that by the units in beginning inventory. That is, what did we have in inventory going into this period to get us to the units we need to produce. And so this is just the basic format for the production budget. So now let's look at an example of one of those. And this budget is out of your Exhibit 9-6 out of the text. So we know that we had 30,000 units that we were going to sell and projected to sell from our sales budget in January. And then we want to add to that to some desired ending inventory level. And so for here, we just are assuming we want 200,000 units. So we need to produce 32,000 units during the month of January. However, we may have some inventory available that we had going into the month, and here we assume that we had 3,000, so we reduce the units we need to produce by what we had coming into the month to get us to 29,000 units to produce. In February, we said we were going to sell 20,000 units, right? And what is our desired ending inventory in February? And here we'll assume 2,500, so we need to produce then 22,500. But we know, based on January planning, we had targeted an ending inventory in January of 2,000, which becomes the opening or beginning inventory in February. So we back that out to get to 20,500. And then finally, in March, we know we're going to, or targeted to sell 25,000 units. We have a desired inventory that we're given of 3,200 units, so we have to produce 28,200. But we also know, or we need 28,200, but we also know that we had 2,500 units in beginning inventory coming into the month, so we have 25,700 units that we need to produce. And if we sum all those rows then, right, except the desired ending inventory, because that's not a sum, it's what we desire in our inventory at the end of the first quarter, right, so at the end of March, we can still get to what our first quarter activity ends up being as far as units to produce. And so that's how we translate the sales budget into the production budget. And so next then we need to look at the direct materials budget, right? And so that's similar in completion to the production budget. The basic format is that we take the quantity of direct materials needed for production, and we just calculated the production budget, and we have a list of materials that go into our product, so we're able to determine the quantity of direct materials needed for production plus the direct materials needed for ending production, which gives us the total quantity of direct material we need, less the direct material we have in our beginning inventory, which gives us the quantity of direct materials that we need to purchase for that period. So now let's talk about how we turn that direct materials budget into a monthly and then quarterly direct materials budget, similar to how we did our production budget. So now we can look at how we develop a direct materials budget, and that's given to us in Exhibit 9.7. So we know that from January, from our production schedule, we're going to produce 29,000 units. We're also told that the quantity of pounds of direct material are 5 pounds per unit. So that tells us the quantity of pounds we need for production are 145,000 plus. We know that we want to have, per the problem in our ending inventory, 10% of the material that we need for the next month's production, and that way we don't have to shut down our product line if a vendor or a supplier is late. So we need to know what are we going to schedule to produce the next month, and we're given that we're going to produce 20,500 units from the production budget at 5 pounds per unit needed. Direct material is 102,500 pounds of material needed for the next month. We want to keep 10% of that in our current month ending inventory to prevent shortages from crippling us. So we know we need 10,250 pounds of material in our ending inventory. So the quantity of material we need to buy in January is $155,250. And we're given that we have beginning inventory of 14,500. So the difference between the 155,250 and the 14,500 that we had in to begin with at the beginning of January is the quantity of pounds we have to purchase. We know it costs us $1.50 a pound to buy it, so we expect our total cost of direct materials purchases for January to be budgeted at $211,125. So if we go through that same process for February, we know that we have 25,700 units of production scheduled for March at 5 pounds per unit. So we have 128,500 pounds of material needed for production for March. That tells us that we need 12,850 pounds of material in our ending inventory in February. We had the total quantity, which gives us our total quantity of pounds needed of 115,350. But we also know that at the end of January, we had budgeted to have 10,250 pounds of material in our ending inventory. So we can reduce what we need for February by the amount that we had in the ending inventory, which says we'll need to buy 105,100 pounds of material at $1.50 a pound, or 157,650, and we go through that same calculation then finally for March. We know that we'd have to do that calculation for April to get us what our desired ending inventory would be. But for purposes now, we'll assume it's 16,150, and so that tells us we need 144,650, but we know we've got 12,850 pounds of material on hand already, so we reduce the 144,650 for the 12,850 to get 131,800 times the $1.50 a pound to get us to 197,700. So during the first quarter, we're going to produce 75,200 pounds, or 200 units. So we'll produce January plus February plus March. We're going to need 5 pounds of material to do that. So we're going to need 376,000 pounds during the first quarter of material. But we know that we also want to keep, at the end of the first quarter, we want to keep the ending inventory that we want to meet April's cushion of 16,150, which tells us we need 392,150. And we also can assume that we've got 14,500 pounds left over from the coming into the first quarter, right? That was the 14,500 from January, to tell us we need 377,650 pounds of material to purchase times $1.50 a pound. So our purchases would be 566,475. And so it's kind of this iterative process that we're projecting. Sometimes we're carrying amounts backwards in order to understand what our quantities are necessary, and sometimes we're carrying amounts forward with respect to beginning inventory and ending inventory amounts. But again, this direct materials budget, you can see, is very closely tied, or directly tied, to our production budget, which we talked about in Exhibit 9.6. And so then we look at our direct materials budget, and again, it's very similar. So we talk about the units to be produced times the direct labor hours per unit, right, to give us our total direct labor hours needed, times the cost per direct labor hour to give us our total direct labor cost. And so we can go through the same process that we went through with our direct materials budget. Again, it ties back to our production budget, which ties back to the sales budget. And that's why we see that these budgets are all kind of built upon one another and very, very integrated. And so if we just walk through this example very quickly, again, for January, we said our production budget was going to be $29,000. We're given that we need 0.05 direct labor hours per unit, so we need $1,450 of total hours required in the month of January. We don't have to worry about opening inventory when it comes to direct labor hours because we can't really inventory direct labor hours. So we know we have to pay $22 an hour, so direct labor hours for January will be $31,900. We can do the same for February at 20,500 units of production to get us the total direct labor for February of 22,550, and we do the same for March at 25,700 units of production to get us that we are going to have to buy 1,285 hours that month at $22 an hour, or 28,270. And so if we extend all of these amounts through to the end of the first quarter, we see what our first quarter direct labor budget would be, and that's in Exhibit 9.8. And so then finally the next thing that we have to do is to go in and talk about, well, how do we budget manufacturing overhead, right? Because we're going to apply manufacturing overhead as well. And so this exhibit is on page 525, it's Exhibit 9-9. So again, we see that we have units of production, right? So first, this budget is again highly dependent on cost behavior, right? So we know that we have both variable and fixed manufacturing overhead costs. We know that in January we've got 29,000 units to be produced from our production budget, 20,500 for February, and 25,700 for March. All of those numbers should look the same. Then we know that we have these indirect variable overhead costs, and we have these fixed manufacturing overhead costs. And we break these down so that we're able to budget for them each month the way we see that we've done here, so that we can get to our total manufacturing overhead at the end of each month. So this again is nothing more than identifying these overhead costs and determining which ones are variable and which ones are fixed, and then reflecting them accordingly in the overhead budget. So then we have our operating expenses budget, right? We said that our manufacturing overhead, we have direct costs, that's direct material and direct labor, and we have manufacturing overhead, and we budget those. And then we have our operating expenses, right? So these are functional in nature. Some operating expenses are variable, and then some operating expenses are fixed. And so for the operating expenses that are variable, we have to calculate what those variable costs are based on, for instance, sales commission per case is $1.50 per case. So that times what we expect to sell, right? So these are sales. What we expect to sell would be the sales commission expense, and the same with shipping expense and bad debt expense. These are all variable operating expenses that tie to the number of units budgeted to be sold. Then we look at our fixed operating expenses, and obviously these are fixed, and so they don't change each month. And so here we can see a budget for our monthly budget for the quarter ending March 31st for our operating expenses budget. And then we talk about how we can budgeted manufacturing costs per unit. So we want to know, well, how much do we budget to cost each month per unit, right? So we have direct materials, and we were told that we're going to use 5 pounds of corn flour at $1.50 per pound, right? So that's 5 pounds per case at $1.50 per case. So there's $7.50 of direct materials per case. There's 0.05 hours per case at $22 per hour, so that's $1.10. Then we have our manufacturing overhead, both variable and fixed, and we can walk that through to see that it's variable manufacturing overhead costs $2.50 a case, fixed manufacturing overhead costs 90 cents a case. So the cost of manufacturing each case, the budgeted manufacturing cost per unit, and a case is a unit, is $12 per case. And note Exhibit D that says, recall that companies base their predetermined manufacturing overhead rate on the total estimated cost and volume for the entire year rather than on monthly costs and volumes that will fluctuate. And then we can also take the same exercise and we turn that then into what our budgeted monthly income statement is. And so for January, we see that we had budgeted to sell 30,000 cases at $20 per case. So our January revenue is budgeted to be $600,000 less the cost of goods sold, which we just calculated per case of $12 times the 30,000 cases. So we get a $360,000 cost of goods sold. That equates to a gross profit of $240,000. Our operating expenses we take right off of our operating expense budget, and that was Exhibit 9-10 of $142,800 to get operating income of $97,200. We didn't calculate any interest expense, but we do have income tax expense, and we're given that the corporate income tax rate for most companies is currently 35% of income. So we take $97,200 times 0.35% to get our income tax expense of $34,020. That gets us down to our budgeted net income for January of $63,180. And so you can see that we've done exactly what we said we were going to do. We took the sales budget, we turned it into a production budget, which we turned into a direct materials budget, a direct labor budget, manufacturing overhead budget, and then into an income statement budget for each month. And so then the next step is to prepare the financial statements. And just like the prior budgets, there are several different financial budgets. These different budgets consist of a capital expenditures budget. So what are we going to have to invest in the organization? Are we going to have to buy new equipment, upgrade our facilities? Are we going to have capital expenditures? And if we are, we need to identify those up front and plan for them and budget for them so that we have adequate cash or the other necessary resources to acquire capital expenditures with. We have a cash collections budget. So when are we getting paid? We saw earlier where we had estimated a mix of cash plus credit sales. So based on that, when do we think we're going to be paid for our credit sales, right? Is it 30 days, 45 days, 60 days, 90 days? What does history tell us? We have a cash payments budget. So we talked about a purchasing budget, knowing how many units we're going to produce, the need for the direct materials, and how much direct materials we're going to have to pay for that. So we need to budget the cash outflow as closely and as diligently as we budget our cash inflows. But together, this gives us our combined cash budget, and then all of these combined, we're able to get a budgeted balance sheet. And so this shows the company's plan. It's Exhibit 9-13, shows the company's plans to invest in new property, plant, or equipment. And all we're saying here is that, well, we are budgeting for January to spend $15,000 on computers, $35,000 on delivery vans, and $75,000 on production equipment. So new investments in property, plant, and equipment are budgeted for $125,000 in January. And we would do the same for February and March if we, sometimes we spread our capital expenditures out since they are generally significant expenditures. But in this case, we're not budgeting anything for February or March. And this is Exhibit 9-13 in the book. And so here what we're doing is just showing an example of how we budget for cash collections, right? So we're given that we have what we expect our cash sales to be from our sales budget, and then we have to calculate the collections on the credit sales. And so we're told that 85% of our credit sales are paid in the next month, and 14% of our credit sales are made 2 months later. So anything we sell in January, essentially we're collecting in February, or 85% of that we're collecting in February, and then 14% of it we're collecting in 2 months from January or in March. So if we look at January, we had credit sales or cash sales of $120,000. We have collections from credit sales, so we have to calculate and post 85% of credit sales made 1 month ago and 14% of credit sales made 2 months ago. And if you recall, we had a mixture in our budget, I believe, of 80% being cash sales, and 80% being credit sales, and 20% being cash sales. And so we're just taking those amounts that we projected under that scenario, and then applying what our average historical collection experience has been, in order to determine what our cash flows for each month are going to be. And so we do that for each month as we show here. So again, similar to our cash collections, we also have to build a cash payments budget, so that we know when are we going to be spending cash. If we know when we're getting it, we also want to know when we're going to be spending it. And so in this case, we're just simply looking at what cash outflows do we have each month. And so we have cash payments for direct materials, for direct labor, for manufacturing overhead, for operating expenses, and then for months where we have capital investments or capital expenditures, we have cash payments for those as well. We have no cash payments for income taxes at this point in January, February, or March, but we do budget for the outflow related to a cash dividend. And so you can see all we're doing here essentially is taking anything that we would have to pay out that month and putting it in a budget, so that we can, in a month where we have we're able to match our cash inflows and our cash outflows. And in a month where we have a deficit, we have a line of credit or some other means of accessing cash. And in months where we have surpluses, we can cover the deficits and perhaps plan for how we want to invest those amounts, and then for how long, based on how long it will be before the next month where we have a deficit. So that's why we build. And much larger companies generally have lines of credit and other facilities to accommodate temporary cash flow shortages. But the smaller the company, the more important the cash budgeting process becomes, and the more critical it is that companies monitor their accounts receivable and to make sure that they're getting paid as quickly and as soon as possible. If we combine the cash budget, right, we're able to look at the way we have here. So we start with the beginning cash. We add to it our cash collections that month, which we got from our cash inflows budget. That tells us the total cash available. We deduct from that the cash budget that we developed in Exhibit 9-15 to get our ending cash balance. And so in January, we show that we have a deficit. So we have to invoke borrowings of $20,000. So we have some cushion and an ending cash balance of $15,000, which becomes the February beginning cash balance. And we go through the same additions and subtractions, and we find that we have an ending cash balance of a positive $174,130. And so from that, we repay the $20,000 in borrowings that we had, whether it's from a private borrower or from a bank, and we have some interest on that we repay, to say that at the end of the month we expect to have approximately $154,000 in February, which becomes the March opening balance. And we continue to do this calculation month in and month out for the year, so that again, we can just manage our cash, and we don't look up one day and we don't have money to make payroll, or we're not able to get materials because we aren't meeting our vendors' payment terms. And we convert all of that into this budgeted balance sheet. This idea of cash payments and cash receipts, the idea of investments and what the investments do, or the our capital expenditures and what they do to our balance sheet. But anyway, the goal of all this is to also, like we did with our sales budget, the ultimate goal was to produce a budgeted income statement. We're able to produce a budgeted balance sheet, which we're given here in Exhibit 9-17 of the text. And so next we want to talk about sensitivity analysis again. And we talked about this in a previous chapter. If you recall, sensitivity analysis gives us the opportunity to develop a what-if technique that asks what a result will be if a predicted amount is not achieved, or if an underlying assumption changes. So what if demand is less than or greater than expected? What if our shipping costs increase or decrease due to an increase or decrease in fuel costs? What if the cost of raw materials increases or decreases due to a labor cost increase or decrease? Or suppose that the sales mix that we talked about earlier, that were 85% cash, or that we assume might be 15% cash and 85% credit versus what we expected at the beginning of the year of 20 or 80 cash credit respectively. How do those types of changes impact our budgeting process and what we may need to buy, what cash we have available, what we're able to pay, and so on? That's this idea of sensitivity analysis. And most certainly we don't want to forget about the nexus of sustainability in budgeting, right? We should have goals for sustainability reflected in the company's budget. That's a clear indicator of how serious we are about our Going Green initiatives or our focus on sustainability. We have long-term sustainability goals that often will affect short-term budgets, right? Sometimes we have to make short-term sacrifices to achieve long-term goals, particularly with respect to sustainability, that at a lot of times don't have returns available until way down the road. And then we can use this as a benchmark for judging our performance. So in our objective 4, we want to talk about a merchandiser's cost of goods sold, inventory, and purchase budget versus what we had been talking about up to this point, that being a manufacturer's. So for services companies, we don't have merchandise inventory. So we're really looking at developing operating budgets. And with operating budgets, we still have, that's what guides us in our day-to-day operations. So we still have sales budgets, operating expense budgets that get us the budgeted income statement that also allow us to develop financial budgets. And so all of this is the same with respect to a service company as it is with a manufacturing company. It's just that we don't have to worry about merchandise inventory in a service company. So for merchandising companies, these companies' budgets include the sales budgets, a cost of goods sold, inventory, and purchases budget. And we talk merchandising, right? We're talking retailers, so they would have inventory, right, that they would have to purchase for resale. We can translate that into an operating expense budget, a budgeted income statement, and then the financial budgets are the same. We also have a cost of goods sold, inventory, and purchases budget that generally will start with the cost of goods sold plus the desired ending inventory, which equals the total inventory needed. We can reduce it by the same beginning inventory we talked about thus far to get to the purchases of inventory that we need for that period. So this just gives us an example of the merchandiser's cost of goods sold, inventory, and purchases budget. And as you can see, it's very similar to our previous examples that we walked through. So I would encourage you to go in and look at Exhibit 9-21 and make sure you can feel comfortable with where these amounts came from with respect to a merchandiser and not a manufacturer. Then we have to talk about the impact of credit and debit card sales on budgeting because there are certain characteristics of these types of sales that we want to factor into the budgeting process, and there are certain implications. So credit card companies and their issuing banks charge merchants a transaction fee for each purchase made using plastic. So we want to factor into our revenue amount or into our expense some transaction fee so that we don't overstate profit. Right? The merchant receives the entire amount of the purchase less the transaction fees. And this is usually, could be 1%, 1.5%, 2%, could be 4%. It just depends. And this would be as if somebody uses like a Visa or a MasterCard or American Express to pay for their bill. Well, the vendor is going to get, or me as the vendor, I'm going to get what I would charge that customer for that product less a transaction fee, generally reflected as some percentage of the transaction, very small percentage, but it's the percentage nonetheless, and we want to take that into account. The benefits are that if we might lose sales if we didn't allow customers to use credit or debit cards. It decreases the cost associated with bounce checks, misappropriation of cash, and activities associated with preparing and transporting cash deposits. And we also receive these cash payments much more quickly than if we gave credit to the customer, or they charged the goods and ended up paying us 30 or 45 days. We usually can get same-day or near same-day deposits into our account of the amount of the transaction less the transaction fee. And so again, we talk about we could issue store credit cards, right? So now we're not talking about a Visa or a MasterCard that goes through a bank. This is a credit card issued by the store. And there we may have no transaction fee incurred because the store or the merchant assumes the risk of collection. We have to wait for customers to make their payments, right? So under the other credit card scenario, right, under the bank credit card scenario, payment was almost simultaneous. But here, if the store is issuing the credit card, we have to wait for for the customer to make the payment. We have to develop a cash collection budget, which involves the aging of receivables. We have to include in our operating expense budget bad debts from clients who don't pay, and then we have to budget interest, income, and late fees that we would theoretically collect from customers. And so that concludes Chapter 9 of our text. I hope that this helps, and that once you've read the chapter, if you haven't already, that this will just simply supplement your understanding of the reading. But please don't hesitate to let me know if there's anything that you don't understand, any clarification, and I look forward to talking to you regarding our next chapter. Thank you.